just be relating. I won't just be relating them to you in abstract. So once we pick on one particular one, I will take you to the trading chart so you can see for yourself. You see, and this is very, very unusual of the trading chart away for a while, but you see, they say you don't change the winning strategy. In the same way, you have a strategy that is not winning, if you're able to change it, you see. So I think I want to change that strategy this time around by getting you used to the chart earlier. So allow me to share my screen. You said what?
Sure. Yeah, sorry to cut you short. I just wanted to quickly say, is it possible we have, okay, I've observed that the interface, the web interface is different from the mobile interface. So while showing us the charts, are you going to be showing us that of the web or from the mobile? If you can show us the two, I'll be very happy.
I would have loved to do that, but I can't do the web interface now.
Oh, that's okay.
But you see, I think that's Kunle, right?
Yes.
Okay. You see, Kunle, sincerely, I really don't think there are so much of differences between the two. You see, I just believe it's a matter of how well you can customize your chart. You see, I love my chart on a dark background. I really look out for so many things and I want to be very, very careful with them. So my chart is on a black background. You see, the web interface will be on a white background. And so it depends on how you're able to customize it. We'll talk about them. You understand what I'm saying? Did you get that?
Yeah, I got that. Go on.
Okay. So allow me share my screen so we'll start straight away. Okay. Okay, so like I said, we're starting with Forex trading basics, the terminologies now. Now, one of the things that the so-called pros using scaring people away, most
is everybody hearing Sean? I'm not hearing anymore.
I'm not hearing him too.
Okay. Yeah, it must be the network again. We'll be back. Thanks for your patience. Let me reach out to him hopefully. Okay. Hey, Hodon, how are you? Let me reach out to him hopefully. The nose is off. Yeah. We need to get this juicy part today. All right. Thank you, Jesus. Ooh. All right. Come on, come on, come on. Let's see. Yes. It's back. Excellent.
Okay. So sorry, I'm so sorry about that.
No problem.
Yeah, I was having issues with with the internet, so I had to change my provider. So let's just continue now. We need to be very, very fast, like I said. So
All right. Thank you.
yeah.
Welcome back.
Okay, so I'm sharing my screen again. I was talking about currency pairs. Okay, I was talking about currency pairs. Now on this particular page now, I have four items I want to look at: currency pair, exchange rate, base currency, and code currency. I will take them now and I will take you to the chart, you see. So now, like I said, the currency pair, we always have things like pounds USD, euro USD, USD JPY. They are always paired two, one on the left, one on the right. You see, now then we have the exchange rate. The exchange rate is the rate at which the two paired currencies are exchanged in the forex, in the foreign exchange market. Then we have the base currency. That's the currency that comes first, which, for example, when you have the pounds USD, the pounds is the base. Then you have the quote, which is the second one. So now let me take you to the page now to explain, to the chart, so you can understand what I'm saying. So I'm looking at currency pair, exchange rate, base currency, and code currency. So allow me to share my trading chart, sorry. Okay, now, if you can see my screen, kindly let me know, please. So this is my chart. We said currency pair. If you look at the left hand of my trading chart here, if you can see my cursor, you see pounds USD. That is an example of a pair. Is anybody with me?
Yeah, I can hear you loud and clear.
Okay. So this is a pounds USD pair. This is an example of a currency pair, a pounds USD pair. Like I told you, it could be euro USD. You see, it could be pounds JPY, GBP JPY. So it's always two, one on the left and one on the right. Now, remember the first one we said was the currency pair, and I just showed you one, pounds USD. Like I said, it could be something else. It could be this. It could be Australian dollar, Canadian dollar, like you have here. You see? So it could be Australian dollar, Canadian dollar, like we have here. You see that? This is Australian dollar, Canadian dollar. It could be, let me give you another very good example. It could be maybe, yes, one other major. Okay, it could be New Zealand dollar, JPY. You see, this is New Zealand dollar, JPY. You see, so that is a pair for you. You see, that's a pair for you. Now, we now said the exchange rate. You see, now, what is the exchange rate? That's, we said that's the rate at which the two currency, the bid and the ask, will get there to, don't worry. The base and the quote, I mean the same thing. The rate at which they exchange. So let me come back here again. Now, what we have here, this pair is New Zealand dollar JPY. If you ask me, if you wake me up now and ask me, what is the exchange rate? All I need to do is come to my trading platform, come to the right hand, kindly follow my cursor. I will try not to be too fast. You see, on this right hand here, if you can see my cursor moving down, where you have 76.645, 76.510. Now, the present exchange rate for Japanese yen against New Zealand dollar is 76.730. You see, don't worry, don't bother yourself. It may change to 31, 32, 33. I'll get to that, why it is changing. 31, 32, 33, 34, 35, 36, 37, 31, 32, 38, 40. I will come to that. So presently now, if you wake me up and ask me what is the present exchange rate for the GPY trading against the New Zealand dollar, it is 76.730. Now it is 732. That is the present exchange rate, globally accepted. You see that? So for this pair, these times are now coming to play. Just follow me up, you get them. This pair has this exchange rate. You get it? New Zealand dollar JPY as a pair, as a currency pair, talking about the terminologies, as 76.727 as the exchange rate, according to what I have before me on my trading platform. You see that? You see the way I combine the two terminologies? This currency pair has this figure as their exchange rate. Let me take you back to pounds USD. Pounds USD. Now, pounds USD now. Pounds USD. Now, pounds USD is a currency pair with an exchange rate right now, as in global price, 1.37599. You see that? The pounds USD is a currency pair which is trading at the pounds USD is a currency pair with the USD trading at an exchange rate of 1.37589 against the British pounds. You see? So what you have here is the exchange rate of the quoted currency will come there. So what is the base currency and what is the quoted currency? The base currency is the currency on your left. So as far as this pair is concerned, this pounds USD, pounds is the base currency and the USD is the quoted currency. So the figure you have here, changing per seconds. I use that word because I'm coming to what it really means. It is not per seconds, it is per pips. So this currency changing per pips is the exchange rate of the quoted currency, which is the US dollar, against the British pounds. Mrs. Adebola, are you getting it now?
I'm getting it.
Please, I want you to get it this time around. I want you to get it this time around. Now,
yes.
Yeah, people may not, many of us may not have this opportunity again until maybe about this time next year, because this kind of classes won't be coming up regularly. So surprising, the real group that I had in mind did not register for it. So the fact that you guys are here now is a very, very big privilege, you see. So please, let's mindfully follow these terminologies. You get it right, I can assure you. So pounds USD, I'm going over it again. Pounds USD is a currency pair with the British pounds as the base currency and the USD as the quoted currency. Now, the quoted currency presently has as its exchange rate 1.37586.
Progress.
You see that? You want me to take that again, or we should move on? Should we take that again, or we should move on?
Okay, unless anyone is saying otherwise, I think we should move on.
Okay, okay. So let's move on. So let me go to the next slide. Okay, can you see my screen now? Can you see my screen?
Yes.
Okay, so now I have on this particular page, long position, short position, bid price, ask price, spread, and appreciation. You see, now many of these, well, maybe for some of them, some of us may not be used to some of them, but if you are the typical business person, some of the terms are these general terms, but they might just mean something that has a slight, that has a different meaning slightly from what we used to know now. The long position in Forex means buy. The short position means sell. You see, long position means buy, short position means sell. So if I see you, Kunle, in the market, and I have a novice beside you that I really want to throw into the dark, and I say, Kunle, you're trading pounds USD, are you going long? What I'm asking you is, are you buying? Or I say, Mrs. Adebola, you're trading Euro USD, are you going short? You shouldn't be going short today. You should be going long. I'm saying you shouldn't be buying today. You shouldn't be going long today, you should be going short. I'm saying you shouldn't be buying today, you should be selling. So now let me now take you back to my chart to now tell you what it means to buy and what it means to sell, what it means to go long and what it means to go short. Okay, so back to my trading chart. This is pounds USD on a 1 hour time frame. Now, We said going long is buying, going short is selling. When do you go long? When do you go short? In other words, when do you buy and when do you sell? You see, now, when the trend, what you have here, these are candlesticks, we'll get there too. This is a candlestick chart. There are three kinds of trading charts. You have linear, you have candlesticks, and you have, just hold on. Okay, you have linear, the line chart, you have the candlesticks, and you have the bar charts. That's the three of them. The bar chart, the linear, and the candlestick. So the candlestick is the most preferred because it gives you a perfect picture of what the trend has been like, depending on the time frame you're trading on. So I'm always on the candlestick chart, which is this particular one. So now you buy when the market, when the trend, or when your quoted currency is depreciating. That is when you buy. And you sell when your quoted currency is appreciating. So when you go short, what you are doing is you are trading an appreciating market. When you go short, the market appreciates when the trend is on a downward movement. It depreciates when the trend is on an upward movement. So when you are going long, you are buying a depreciating currency. And when you are going short, you are selling an appreciating currency. Of course, when you sell, you are selling to make profit. And of course, when you are buying a market, a trend, a pair, a currency which is depreciating, you are making profit also. If you are buying a Toyota Camry, for example, when the price is falling, you can be rest assured that when you be selling it again, when it will be appreciating, you make profit. So that is what it means to go long and to go short. You see, as far as this pair is concerned, this pounds USD now, this trend is going up, upward. That means the USD is depreciating against the pounds. So if I wake up tomorrow, if you wake up tomorrow and you see this exchange value around it is presently as 1.37594, and you wake up and you see it around 1.36095, that means the US dollar is appreciating against the British pounds. Any question?
Please, can you take that again, please?
Thank you very much. Now, I was saying something about going long, which is buying, and going short, which is selling. You buy when the market is depreciating, and when you sell when the market is appreciating. Now, point of notice, when you are selling when the market is depreciating, you will lose money. When you are buying, so be mindful of this fact. You buy when the market is depreciating. In other words, when the market is going up. That is a layman's term. You buy when the market is going up, and you sell when the market is going down. That is a layman's description. You see, so you buy a depreciating market upward, You sell an appreciating market coming downwards. Don't sell when the market is depreciating. Don't buy when the market is appreciating. If you go against the trend, you will lose money. I know the question might be, how will I know when the market will go up? How will I know when the market will come down? We will get there. When we come to market analysis, you see the different kind of analysis, you understand what I'm talking about. Let's take it one step after the other. You buy going long, you sell going short. And those are the two major activities in the market. It's either you are buying or you are selling. And like I always say to jokingly, or you are just watching the market. Sit down, look. So you are either buying, going long, or you are selling, going short. Did you get that? Can we continue?
Yes.
Did you get that? Oh, thank you, Kunle. Ms. Sadibola, can we continue?
Yes, sir.
Okay,
Can
okay,
continue.
okay, thank you. So let me go back. Okay, so now the ask price, which is the market price for purchasing a particular currency. Then the bid price, which is the price at which the currency is being sold. Now, where do you see the bid price and where do you see the ask price? I will take you back again to the chart. Now, I won't take appreciation again because I've handled that talking about appreciation and depreciation. So I'm going to leave that out. So I'm going to ask price and bid price and the spread. You see, so I'm taking three things now: bid price, ask price, and the spread. Bid price, ask price, and the spread. Don't forget. So let me go back. So, okay, now I'm back here. You see, now, when I've finally done my analysis, we will get there. You see, the analysis I'm talking about is knowing when to buy and knowing when to sell. We will get there. Don't bother yourself, one step at a time. Now, I have done my analysis on this particular market and I want to buy. Or I think after all my analysis, I want to sell. When I come here, you're getting used to this platform now, which is an MT4 platform. There are different trading platforms. We will get there too, one step at a time. If I want to, after I've done my analysis, I want to place an order and I come here, kindly and gently follow my cursor. I come to new order. You see that? I come to new order. Now, this particular box is quoting the currencies for me in the bid and their ask prices. The bid and their ask prices. If I want to sell and I come here, I can't click this because this is a live market for me. I'm on a live chart, so I won't click. If I click sell, you see, I will be selling at the rate you are seeing. Are we seeing this box? At 1.37576. So the point at which I click now is the point at which I will enter into this market selling. You see that? Or if after my analysis, I thought I should buy, I come here, you can see buy the market, sell by market, buy by market. If I am not selling and I decide, okay, I want to buy, if I click buy, I will buy into this market at this rate, 1.37578 or 9. So if my analysis is correct, every movement, which of course I refer to as pips, that this trend makes, gives to me profit depending on my lot size. I will get there. Just follow me one step at a time. You see? So this is the bid and the ask price. You see that? Now, if I decide to sell, you see, if I decide to sell, because some of you witness it from Monday next week, we'll start doing one or two, placement on our demo account. So you see, so over the weekend, that will be your assignment. You're to open a demo account with any broker of your choice. We'll come to that too. So now, if I decide to click sell by market now, if you do so, you discover that your market will start on a negative. You might be wondering, I just placed a trade and my market is, if for example, you are trading a Naira account, you said my market is starting on minus 300 Naira. Now, the 300 Naira, which is the minus, is the spread that you are being charged by the broker, which is the difference between the bid price and the asking price. So when you enter the market and you see negatives, don't worry yourself. Those are charges. You see, when you open your account, whether it's demo or real, you have agreed to those terms. And if you don't agree to them with some brokers, you can't open an account with them. So because you have agreed to those terms, they remove the spread. You see, so that is for the bid, the ask, and the spread. They are majorly, they majorly take place when you are placing an order, when you are executing a trade. Did we get that? Can I continue? Did we get that? Can I continue?
Yes, sir.
Wow, thank you very much. So let me go back. Okay. So okay. So now I've been saying peeps, peeps, peeps. Now there is peeps for us to talk about. You see, now here I have the peeps, I have the lot, I have the leverage, and I have the margin. Pips, lot, leverage, and the margin. You can take time. You see, if you lay your hands on the recording, you can go over them again, and I don't want to bother you with you reading and reading and reading. So I will do the explanation. So by the time you now read, you pick them once and for all. These things are so easy. You see, it is people that want to make it look like a masquerade, that want it to look so big. Simplicity is the mother of all. It is the best sophistication. You see, so I'm going to take pips, lot, leverage, and margin now. So what is a pip? Now, pip simply means percentage in points. You see, now let me go back. Pips, lot, leverage, and margin. PLLM. So I'll remember. So let me go back to the chart. You're getting used to the chart. Something so unusual. I think Mrs. Adebola will be wondering, I wish you should have brought the chart earlier. Don't worry, we're learning, we're all learning. Now, this is the chart again. You must get used to it, you see. Now, what is the pips? We say the pips is the percentage in point. Now, if you look at the right-hand part of this chart, which is where you have the exchange rate of the quoted currency, which in this case is the USD. You see it changing. 7.7, now is 7.8, is 7.9. The last figure is the pip. You see, I'm talking of one now. It could do multiple at a time. So if it moves between 7.9 to like 9.8, that is, it has gone so many pips. So if I see you trading, Kunle, and I say, Kunle, how many pips have you made today? And you say, well, I've made 30 pips. You have said 30 pips profit. You are saying, when I entered into the market, it has gone in my direction or in my favor 30 pips. So the ticks, like seconds, the pips is your profit. That is what determines your profit if your analysis is correct. If your analysis is wrong, you will lose according to the pips. You see that? So if you enter at 1.37579 and you are selling, if this market moves to 1.37400, you would have made nothing less than about 100 pips. Let me give you a very good example. You get used to this icon, just calm down. If I bring on my cross here from where this market is presently, if it moves in this direction, you would have made about 10 pips profit selling if your analysis is perfect, if your analysis is correct. So the pips is the movement. You see that last figure changing with time. That is the pip, the percentage in points. So it determines the profit that comes to you, that you make, or the loss that you make per time. That is the pip. So now what is the lot, which is the next one? Now, the lot is the quantity of profit you make per pip determined on your envisaged determined on your envisaged profit. The profit you make per pip determined on your envisaged profit. You see, the profit that you make per pip, for example, you want to make $300. You see, you want to make $300 and you just want to trade 10 pips. That means you go for like 30 lot size, meaning for every pip you are making a profit of 30. So 30 profit, 30 profit per pip, 30 profit second pip, 30 profit third pip, and by the 10th pip it is 300. So it is profiting through the pips until the last profit. But if it goes against you, if your analysis is wrong, it will be loss per pips until the last loss. What do I mean by that? Let me open the order box for you so you can understand very well. You see that if I come here, I want to place an order. I come to new order. You see that on a pounds USD, just like I showed you the other time, trying to explain the bid and the ask price. Now, if I come here, can you see 0.03? Can you see that? 0.03. Can you see that? Where you have volume. You see symbol next to symbol is volume. Can you see that? Yeah,
Yes.
thank you. Yeah,
Although on a mobile interface, but I understand.
Okay. So if I click on the down arrow, you can see that I have 0.01, 0.02 down to 8.00. Now, 0.10 should be $1 on many MT4 platforms. 0.10 is $1. So anything lesser than that will be trading for you. For example, now anything lesser than that, like 0.05 will be like 50 cents. You see that if you are trading a dollar account. But if you're trading a Naira account, 0.10 will be like 480, which is the exchange rate or thereabout, or 500. You see, so anything lesser than that might just be like maybe 250 and stuff like that. So now, if I decide to trade 1.00, which is $10, that means when I enter the market, whether I am buying or selling, my profit or loss will be by $10. So if I'm just trying to capture 10 pips, the movement will be $10 per pips. So my lot size is $10. So your lot size per pips determine your profit or loss. Did we get that? So that is your lot size. So when my colleague Omomi will be taking you to psychology, that's next week Monday, she'll take time to explain how this thing can either make you or mar you. You see, because if you are trading using a high lot size, when you don't have the margin or the capital, you have a question? You have a question?
Okay, I actually wanted to ask a question, but maybe the question will be answered when Omomi will be
Along
taking
the line.
over.
Okay.
Yeah. Right.
Okay. So let's continue. Thank you. So if you're, like I said, if you're using 1.00, that is $10. You see, so meaning if you are making, if you are trading, if you're trying to, like, sorry, I think someone will need to mute. You need to mute yourself. Okay, so let's continue. So your lot size determine what becomes of your profit per pip. Don't forget that. So when we come to risk management and money management, you will learn how to use reasonable lot size depending on the size of your capital or your margin. You see, so I've taken pips, I've taken lot size. Now, let me take leverage, which is the third one. Leverage. Now, the leverage is one of the very rare advantage that Forex traders have trading the Forex market. Now, the leverage is granted you by the broker. It is not compulsory. You can turn it down. But it is your opportunity to place trade more on a quantity, on a level more than what you have as your margin. But the disadvantage is that the higher the leverage, the riskier you are opening up your margin to losses. So the smaller the leverage, the safer for you. Leverages could be from 1 to 100 to 1 to 1,000. So that means if your leverage is like 1 to 1,000, which of course you'll be offered when you're trying to open an account, you can reduce it to maybe 1 to 200 or maybe 1 to 500. When it is 1 to 1,000, you have actually opened the account so much for losses. But you see, there are other ways too that you can actually cut those excesses. We'll get to that when we'll be talking about stop loss. All these terminologies, you get used to them because we'll keep repeating them every day and every time. As long as you are in this market, you talk about stop loss, take profit, margin, leverage, PEEP, loss size, you keep talking about them, you see? So then the last one is the margin. Simply put, the margin is your capital. You see, the margin is your capital. And Forex is so automated that you can't place a trade expecting to make a profit that your margin cannot accommodate. That is why I use the word automated. You see, for example, you have just $100 in your account and you want to trade using a standard lot. Once you try placing it, you receive a margin warning or a margin call telling you you don't have a margin that is big enough to accommodate the size of the trade that you want to place. So that is margin for you. So we have taken pips, lot size, leverage, and margin. So let's go to the last one. Let me go back again. Okay. Okay, so now, so risk management, Omar will be talking about this particular one on Monday. She's taking the psychology part of it. The psychology of trading is very, very important because when you're trading Forex, yes, your margin is virtual. You see, your margin, your capital is virtual on your platform. But you see, it is true money that you're trading with. So you have to manage it well. And you need some soft skills to do that. And many of such skills are psychological. So she will be taking that next week. So risk management. Now, talking about risk management, you have to know and you must come to terms with the fact that Forex can make you rich, but it won't make you rich overnight. That is one. Then two, you are always advised to do so much of demo trading. You see, master your strategies, which of course we'll still be teaching you in the subsequent classes. Master your strategies very well, trading a demo account before you go live. And thirdly, trade with a margin that you can afford to lose as a beginner. Because I'm saying you can afford to lose it does not mean you get into the market and you start trading at a reckless level. No. You see, because I said, I mean, imagine you can lose does not mean this one that they say I must lose it. I must lose it. No. As far as you put the measures in place, you keep the open door open, I mean the front door open and the back door closed with some measures we'll be teaching you, you are good to go, even as a beginner. So stop loss. What does stop loss do for you? Stop loss is saying, I have analyzed the market. I have done my analysis. If this market should go against me for reason beyond sight, which of course I'll tell you about when we talk about analyzing the market, then cut me out at this price level. So the advantage you have in this market is it's automated. When it gets to your point, your stop loss point, it will cut you out of the market. The same thing with take profit. You are saying, I want to capture 20 pips. Because I don't have time to be looking at the market, I am busy. I want to place the trade and go and do something else. When the market gets to that profit point for you, it takes profit for you and take you out of the market. You see, so that is how take profit and stop loss works. Then profit and losses, either the profit you make or the loss you make depending on the positions. So let me go back to my chart and use it to explain to you. Risk management, stop loss, take profit, those three. Risk management, stop loss, take profit. Let's go to the chart. Risk management. Risk management is simply money management in Forex. You see? Now, stop loss. Let me use our time is almost up. Now, stop loss now. If I want to place a new order, now it is advisable for you to use your stop loss and your take profit. Now, if you don't want to lose money in Forex, you can't trade Forex. You see, many times people leave the front door open and also leave the back door open. The front door is always the take profit. The stop loss is always the back door. You see, you have to take advantage of the two at the same time. So if I want to trade this particular market right now, and I have set my volume, which is my lot size, to be 1.00, all I need to do is next to my volume is the stop loss. You see, now the market is presently at 1.37597. I want to buy, meaning I envisage that this trend is going long. But if by unseen circumstances, which of course we'll talk about, fundamental analysis, something happened, there was a news that turned the market upside down, I don't want to lose more than 20 pips. All you need to do is count 20 pips downward and enter the figure in your stop loss. Now, you want to capture 30 pips. You calculate 30 pips long, that is upward, and you enter the figure. When you enter the figure, the next thing you do is you click buy. Once you click buy, like I always say, it is automated. Those parameters are in place. If it gets to your take profit, it takes you out. If it does not get to your take profit, if it comes down to your stop loss, it takes you out. You will lose that's about $200. If you have like $1 million, you can come back to the market. You see, but if you were having, let's say, $100 and you are using $10 and your stop loss is 20, that means by the time the currency goes against you like 10 places, which is $100, you've actually lost your margin. You can see how careful you have to be with your lot sizes. You see, so with the fact that you are using a stop loss, you also have to be mindful of your lot size. You see, so that is how the stop loss and the take profit works. From the beginning, as a beginner for you, don't ever trade without a stop loss and a take profit. The stop loss simply tells you that he that fights and run away will fight another day. The market just beat you today, you can come tomorrow. If you don't use stop loss, it will beat you. You won't be able to come tomorrow because your account would have been wiped off. So your take profit is your front door, your stop loss is your back door. Very, very important. This is where we are stopping tonight. Any question? Any question? Any question? Any question, anybody? Mrs. Adibola, Oluwakemisola, Kunle, any question?
I'm here, no question.
Okay.
No question.
Okay. So tomorrow, now this is what we just did, is navigating the market. You see, this is navigating the market. I'm so happy I used the chart to explain. Like, I wasn't just like trying to make you to imagine. So tomorrow we'll take engaging the market. Let's engage the market. And I'll be doing a bit of trying to explain to you what the candlestick looks like. You see, then some of the icons you have on the MT4 trading platform. Now, I use the MT4 trading platform because it is so straightforward. You see, it is so straightforward. You might have seen some other ones, MT4, MT5, so many of them. The MT5 is just a hybrid of the MT4. So the MT4, the MT5, they are just straightforward. So I'll take time to like engage you into the market tomorrow. And over the weekend, I will advise you open a demo account with your choice broker, so that from not Monday now, because some of me will be taking you psychology on Monday. Tuesday, we'll start placing trades, demo trade, and we'll begin to laugh at ourselves. So Mrs. Adebola, I'll begin to see your trading skills. Kunle will laugh at you, making profit or making loss. Kemisola, get ready. We either clap for you or make jest of you. You see, so so get ready. We'll come back tomorrow to continue with, on Friday, Friday, not tomorrow. Friday, Monday, Wednesday, Friday. We'll come back on Friday and continue. So you can even, by Friday, you might have like gotten your demo account ready, but trading proper starts on Tuesday. So before we close the class for today, Mrs. Adebola, please kindly pray for us as we round up the class.
In Jesus' name.
Amen.
In the mighty name of Jesus, Father, we thank you for this time. We thank you for everything we've learned today.
Thank you,
Thank you
Lord.
for all that we're going to learn throughout the period of this course.
Yes,
We
Lord.
ask that you help us to understand and to be able to implement correctly, that this time of learning will not be wasted, but each and every one of us will leave this class with something tangible, a skill set that will help us all through our lives in Jesus' name.
Amen.
Thank you, Father.
Amen. Thank you, Lord. Amen. Amen. Thank you so much. So, good night, everyone. See you on Friday.
Amen.
All right, good night.
Yeah, good night.